Good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly, our look back show for Saturday, December 7th, 2019. Well, this week I sat down with Devin Banerjee, Senior Financial Services Editor with LinkedIn, to discuss the impact of the Charles Schwab acquisition of TD Ameritrade. Let's take a look.
It was actually while I was on a flight, I saw the news release come across, and it had been rumored for a couple days. So this comes on the heels of those cuts across all of these major brokerages to zero commissions. After that happened about a month ago, we saw a lot of the stocks react quite negatively. So these big brokerage houses do, or did bring in a lot of revenue from commissions. One of those brokerages that took a really big hit was TD Ameritrade. About a quarter in its market cap was cut. Which is interesting because Schwab really precipitated these cuts. It was the first to do so, and then TD followed, lost about a quarter of its value. And then clearly now we know that Schwab approached TD for a deal. So it kind of precipitated the drop in value of TD and then swooped in. So this is about a $26 billion deal. It was only announced. The companies say it'll take, if it closes, it'll take about 18 to 36 months to do so.
Wow.
Obviously, the standard in the U.S. is regulators will take a look, although antitrust concern seems to be a bit lower because there are some of these companies with more assets, like actually Fidelity and Vanguard and others. But why this deal? So obviously, after the loss in commission revenue, a lot of these big companies were seeking to diversify their revenue stream. So these companies don't just make money on commissions, obviously. They do custodial services with RIAs and other direct investors and institutions, record keeping, plan design, plan administration. So bringing these two companies together diversifies the revenue mix, obviously gives it a scale, about $5 trillion in assets, a scale that can combat that margin pressure from lost commissions, and obviously it'll have a branch footprint and a merging of its customer base that it can learn a lot from each other. And obviously there are synergies, a lot of the back office work, technical work that these companies do, they can cut a bit there and have some cost savings. So what does this mean for others? Well, for users of these services, for clients, there's still a lot of uncertainty about branding, about service reps, customer service, how that will work. For RIAs, we actually see a lot of RIAs and financial advisors on the platform on LinkedIn coming out and talking about the uncertainty they have, which is to say, a lot of them custody with both Schwab and TD. A lot of them, it's unclear going forward, if they have new clients who come to them with a big account, where they should custody the assets, Schwab, TD, who they should interact with in terms of customer service reps and all that. So a lot of uncertainty, but clearly a big deal. A lot of people are also talking about what does this mean for some competitors. So E-Trade was thought for years to be an acquisition target. After this deal occurred, shares of E-Trade declined. After some people think, there may not be a deal for E-Trade. And a really big question is, what does this mean for Robinhood? Now, what is Robinhood? Robinhood is about a 6-year-old startup, but actually has north of 6 million users in just that time. It's a zero commission broker. And it kind of, because of that zero commission model, kind of incited these other commission cuts across the big brokerage firms. So what does this mean for them now that they cannot compete on price? A lot of people pointing to Robinhood's focus on its technology, its user experience. It's obviously an app-first broker, and its kind of millennial appeal. But it'll be interesting to see going forward what this means for Robinhood, which kind of started all this. It's absolutely true, Jeff. I mean, it's disruption. It's an overused term, but it's affecting all industries, and financial services cannot escape it. Some of the interesting conversation that came out on LinkedIn afterward, this comment from Stu Leventhal I really enjoyed, because he said, if you think about the big brokers from a few generations ago, E.F. Hutton, Shearson, First Boston, Solomon, Dean Witter. I mean, these are names people today don't know. People in financial services, because these companies are gone, or if not gone, they were part of mergers, 2 decades ago, and they've totally transformed into the companies of today. So this is the norm, and it has been the case. Disruption has been the case in financial services for decades, and this is just another step, on that path. If the TD brand goes away and is swallowed by Schwab, people of the next generation in financial services will not know the name TD Ameritrade as well.
Well, Netflix has certainly remained one of the top streaming platforms that there is, but there have been some challenges. Apple TV launched Apple TV Plus, and recently Disney launched Disney Plus. What's the impact to Netflix and its subscribers? Well, I sat down with Daniel Klein of The Motley Fool to discuss. Let's take a look.
So far, there's no impact on Netflix, because if you look at Netflix, it's very much like HBO. Chances are you have shows you're invested in that you're going to want to watch. And yes, some single person users, people that don't have a family, might say, you know what, I'm really excited about the next season of Stranger Things, but I'm not watching anything now. There's 5 things I want to watch on Apple and Disney. I'll turn off Netflix for a while and bring it back. But that's always been something Netflix has had to deal with. We've discussed this. In my family, my wife watches way more Netflix than I do. So it would not be fair for me to say, well, hey, I'm watching The Mandalorian now. I don't need Netflix, and turn it off. So I do think you will see more subscription management, but it's really going to be more downstream than Netflix. It's going to be, geez, do I really need the NBA League Pass on this team I follow? Do I really need, HBO or whatever the lesser things are? Or you might see people say, okay, I'm going to get HBO for 3 months. I'm going to watch all the episodes of last week tonight. I'm going to catch up on whatever series they have now that Game of Thrones is over. They may not have any. And you're going to see more management. But I think Disney Plus has done something that protects them from that, is that when they launched, The Mandalorian was really the only significant new show. I mean, there's a High School Musical series. There are a couple of original movies. All of their big shows are going to come out spaced out. So I'm very excited about the whole Marvel universe of shows. WandaVision, Falcon and the Winter Soldier. There's Hawkeye, my favorite Avenger as a kid, is going to have a series. Those will come out. They will get a huge burst of publicity. And I think in the case of those, they're actually going to release 3 episodes when they launch. And then in the 4th week, 1. So that'll give you sort of a base. But that keeps the water cooler conversation going. That sort of makes it work. And one of the things that I don't like about Netflix is if you love a show, you never know when you can talk about it. It's like, I'm 2 seasons behind on Glow, a show I like very much. So you can't talk to me about it. You might be very excited. You might be done with it. Whereas when a show comes out on a weekly schedule, I think with The Mandalorian, it comes out on Friday. There's kind of an understanding that by Monday morning, it's okay to talk about that. And if I didn't watch it, and I haven't, I'm 2 episodes behind, but I'll watch them tonight, it's sort of on you. And that's a very traditional TV thing, but I think that will keep older people with Disney. Disney had no issue with younger customers. Their library is worth it 1,000 times over. I'm sure they haven't released any numbers, but the vast majority of Apple customers get it for free because everybody who turned over an iPhone, everybody who bought a new Mac, everybody who bought a new iPad, that's a pretty big percentage of the Apple audience. So I don't know what Apple's true vision for Apple TV Plus is, but in my mind, it works a lot like Amazon Prime. Maybe there's a show you like, and it becomes another piece of the moat of you not canceling Amazon Prime because maybe you don't use it for delivery as often now that there's other delivery options and free options and all sorts of crazy ways to get stuff delivered to your house. So if you have an Apple device and your year ends and you're on the fence about getting a new iPhone, might you get an iPhone because you're excited about season 2 of the morning show? But if you look at the actual viewership numbers, and they're very shrouded, but the hit shows on Prime were 700,000 viewers, a failed show on most cable networks, or at least the bigger cable networks. So this is a smart add-on. And, look, you might see, I forget if it's Apple or Amazon, one of them is doing Lord of the Rings. maybe you'll see a show break out that just establishes them the way, like The Walking Dead sort of built a cable network around it, or Breaking Bad and those shows. But right now, the programming is very nichey, and even if it's good, I don't know, but my TV queue, I was away for 5 days. It's going to take me like 2 months to catch up. So I'm not sure I need 3 more good shows, when especially Disney is giving me name brands. And I think this could hurt Netflix eventually. There's no franchises on Netflix. Like, I'm not sure you could build a Stranger Things universe that has 10 shows in it, the way there could theoretically be 10 Star Wars shows and 30 Marvel shows 20 years down the line when they've built out this whole framework.
And when we come back, we're going to take a look at what the financial markets could look like in 2020. So stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network. Welcome back. Markets go up, markets go down, and 2019 certainly has been a year of volatility, political tensions, tariffs, you name it. Well, I sat down this week with Dr. David Kelly. He's the Chief Global Strategist with JP Morgan Asset Management to talk about what could happen in 2020. Let's take a look.
Yeah, well, obviously it's, I think that investing is really much more like climatology than weather forecasting. And if you try and forecast the weather a few months ahead, it's really hard. If you try and figure out what the climate's going to be over the next 10 years in a particular place, well, you kind of know that. And so it's short-term forecasting is very difficult. But I think what's going to happen over the next year, the most important thing to recognize, I suppose, is how politics is going to become more dominant. And there are political differences. I don't want to, I try to be nonpartisan in this, but clearly if the president is reelected, maybe, I think we'll still have tight restrictions in immigration. We'll have perhaps a more aggressive stance on trade. If a Democrat is elected, we could have less of that, but then more perhaps the potential for higher taxes on upper income individuals and corporations. And all of it depends on whether you get one-party government or mixed government or divided government. So that's going to be an issue. That uncertainty is going to be hanging over markets. I think overall the economy should be able to avoid a recession. And that's surprising because this is already the longest expansion since the American Civil War. But when we look at it, we just don't see the sort of boom that would actually cause a bust. We don't have too much capital spending. We don't have a huge boom in cars or houses. There's nothing in the economy which really is set to keel over here. So we think the economy will move forward slowly. We think interest rates will stay relatively low, but perhaps move up a little bit from where they are right now because we think inflation will remain pretty solid and actually pick up a little bit. And then I think U.S. equities could do okay. There'll probably be a little bit more volatility than we saw this year. But I also think if trade tensions diminish even slightly, I think international economies ought to do a good deal better than they're doing right now. And so this could be a year in which the dollar finally begins to come down a bit, and we see international equities do a little bit better than US equities. All of those themes, though, are really ones which we feel much more comfortable espousing for the next 5 years than for the next 12 months. It makes much more sense in the long run to say, yeah, the dollar's too high. In the long run, it's coming down. In the long run, the rest of the world is going to grow faster than the United States. It's almost certain to. And in the long run, interest rates ought to be higher than they are today because nobody's getting paid in real terms on these long-term bonds, and that doesn't make sense. So it's harder to make the short-term points than the long-term points, but those are the trends we see. They're active, and they have been active in the last few years, although they have not moved rates up or down as much as they have in the past. I think the Federal Reserve would really like not to change rates at all this year. They raised them to to what's historically still a pretty low level. Then they cut them 3 times by 0.75%. So we're now below 2% again on a federal funds rate. I think they'd like to stay that way all the way through the year. First of all, I think that they think that's about right for a slow-growing, low-inflation economy. But second of all, I think they want to keep out of the political fray. I think that one thing that all the Federal Reserve chairs, from Jay Powell back to Ben Bernanke and Janet Yellen, they all believe in the independence of the Fed, the importance of the independence of the Fed. They would like to stay out of politics so that politics stays out of their business also. And so I think that's what they're going to try and do, and basically stay low during the election season of 2020. I mean, it's a very difficult time for fixed income investors, and it doesn't seem that way because, after all, fixed income has given you about 8% so far this year. But it's done it as long-term interest rates have fallen by about 1% in an economy with a 50-year low in the unemployment rate, with wages rising. And that's a very unusual situation. It's partly because people are just pouring money into bonds. It's partly because central banks have been so easy. But if you start with these low yields, I mean, the best predictor of the long-term return of a bond is its current yield. The current yield in a 10-year treasury is 1.75. So 1.75% over the next 10 years is not a great return. So I think people need to be cautious about bonds. I mean, you have to have a stable part of a portfolio. I think it's worth looking at. First of all, if you've got a certain amount of cash in your account, make sure that that's invested in something that's pretty good. I mean, you can put, people don't think about it, but there's a difference between 0.5% and 1% and 2%. Yeah. So I think, first of all, get that right. Second of all, I think people should look at equity income, look at dividends as a way to get income as well. I mean, the dividend yield now is above the yield in 10-year treasury bonds. And also, foreign stocks pay higher dividends than U.S. stocks. That's another way to get dividend income. And a third thing that I think people should think about is, there's no law that says you can't sell principal. In fact, a lot of people don't want to sell principal. But if you're decumulating in a low inflation environment, and that means you say you're going to get a 4% income, say, every year, and if that means you're selling some growth stocks on the way up, that's okay. That's all right, so long as the overall so long as you've got a portfolio that's correct in terms of total risk and total return. If you have to sell some principal in the way, if it's not just coupons and dividends, there's nothing wrong with that. I think we have to get out of that mindset that that you can't ever sell principal. So I think we have to be a little bit more inventive there.
In our last segment, state and local governments serve a very important role, but they're facing some hiring challenges. I sat down with Senior Research Associate Gerald Young from the Center for State and Local Government Excellence to learn more about this. Let's take a look.
Well, we've done workforce studies every year since about 2009, surveying state and local human resource directors to get their take on what's going on in their organizations and really what challenges they're facing, how they're adapting to those challenges. And obviously, post-recession, we saw some significant challenges and some significant cutbacks in terms of layoffs or hiring freezes and things like that. But even today, with unemployment as low as it is, we're still seeing quite a range of positions that are very hard to fill. And that's, I think, both due to the nature of those positions, and also to the competition that they face with the private sector. Some of them are police and fire, and that's definitely concerning because that's typically been the type of position that there is almost a cultural mindset with the people that go into those fields that they want to be working in those public service arenas. But there are also a number of positions that much more directly compete with the private sector, such as IT positions, healthcare, engineering. And I think for obvious reasons, when you can find an engineering position that might pay more in the private sector, you might be more likely to go for that opportunity rather than choose or remain in the public sector. You know, we can talk further about pensions more specifically, but I think looking at salaries versus benefits, it's only about half of organizations that see themselves as being competitive strictly on a salary basis. It's, I think, a little bit more constrained not only by budgets, but also by the fact that there is a compensation plan that is in place, and it's very difficult to stray from that. Benefits, obviously, premiums with healthcare plans vary annually. Right. But you also have a little bit more flexibility in terms of some of the non-cash benefits that you might offer to your employees. And that's something that I think gives public sector employers a little bit of advantage, not only in being able to, again, put cash on the table. That's always great if you can, but in terms of flexibility, whether that's, providing for different work schedules, or some of the mentoring or onboarding and succession planning that go into making sure that somebody joining an operation is going to be not only successful at it, but motivated by it.
And that wraps up this episode of BRN Weekly. Hope you enjoyed it, and I hope you enjoyed all of our week of great content. But we're not done, because tomorrow we release our podcast, BRN Sunday, which you can find and hear members of the media, academia, and financial services analyze the news in retirement markets, technology, personal finance, so much more. And then we're back again Monday with BRN AM. So until then, I'm Jeff Snyder. Keep on saving, and don't forget, roll with the changes.
Waiting here for you to take and drink of. But if you're tired of the same